Welcome to this explainer. Today, we're going to unpack the completely fascinating Q2 2026 financial report from Employers Holdings, Inc. We are going to dig in and reveal exactly how this company managed to achieve massive per-share growth despite significantly shrinking their top-line revenues. Seriously, it's kind of like a masterclass in corporate strategy, so let's jump right in and see exactly how they pulled this off together.
Okay, so let's start with who we're actually talking about here. Employers Holdings, Inc., otherwise known by their ticker EIG. As those of us who follow the space already know, EIG is the absolute definition of a niche specialist. They provide workers' compensation insurance that is specifically tailored for small and mid-sized businesses, generally focusing on lower hazard industries.
Now, right out of the gate, their second quarter data throws us a massive financial paradox. If you just glance at their top-line revenue, honestly, you might be a little concerned. Their gross premiums written dropped by nearly 20%, down to $163.4 million. And you know, in most industries, a 20% revenue drop triggers immediate panic mode. But flip over to the other side of this equation. Their diluted earnings per share shot up by an incredibly impressive 29%.
To really put that into perspective, even though their overall net income was essentially flat year over year, sitting right at $29.1 million compared to $29.7 million the year prior, their Q2 earnings per share hit $1.59 per diluted share. And their adjusted earnings per share, it grew by a staggering 46%, up to 70 cents. Just think about that for a second. We're talking about flat net income, a shrinking top line, but massive per share value growth. It literally feels like a magic trick. So the big question is figuring out exactly how in the world they pulled this off.
Well, that brings us to Section 1, Discipline over Volume, which is all about their core operational strategy. This operational strategy is the absolute key to understanding this entire earnings report. Their CEO, Catherine Antonello, is incredibly clear about this approach. She noted that this was another quarter defined by discipline, and that the results of that discipline are becoming visible where it matters most, in their per-share results. She's really highlighting their intentional pricing and underwriting actions here. They actively chose to prioritize profitability over simply writing more policies. Basically, they took a deliberate decline in volume and turned it into a strategic advantage.
So let's look at the operational reality of this. By intentionally shrinking their premium base and weeding out less profitable, non-core business, they successfully lowered key expenses. It's a textbook example of addition by subtraction. Their loss and loss adjustment expense ratio dropped from 70.7% down to 70.2%. Plus, their commission expense ratio improved from 13.2% to 12.8%, which was driven by lower agency incentive accruals and a reduced proportion of new business premiums. Less volume, for sure, but way higher quality volume.
This brilliantly illustrates the nuance of their strategy. While their net premiums earned fell by 12% to $174.1 million, their actual policy count, the policies in force, only dropped by 5% to 127,601. So why the discrepancy? Well, because they focused sharply on their core small business segment. They shed the bulky, low-margin accounts. And by doing so, they naturally reduced their raw underwriting expenses by $3.4 million, trimming the fat on things like bad debt and compensation-related expenses. But let's be real, operational discipline alone doesn't magically create a 46% jump in adjusted EPS.
For that, we move to Section 2, Prudent Capital Management. This is where we look under the hood at their financial engine.
To figure out the rest of that massive EPS jump, we have to look at the super aggressive recapitalization strategy operating behind the scenes. During the second quarter, they returned a massive $34 million to stockholders. But notice the weighting here. It is heavily skewed towards stock buybacks. They allocated $27.7 million to share repurchases, compared to just $6.3 million in regular quarterly dividends. That $27.7 million allowed them to aggressively scoop up 651,752 shares of their common stock at an average price of $42.43 each. You guys, this is the magic multiplier for their earnings per share. When you essentially shrink the total share count in the open market, that flat net income of $29.1 million we talked about earlier gets distributed across far fewer shares. This single financial lever is what directly fueled that massive EPS spike.
And it doesn't stop there. Their balance sheet is working harder for them in other ways too. Their 2025 investment portfolio rebalancing is totally paying off right now with higher fixed maturity yields. This strategic shift actually pushed their net investment income up to $27.4 million, boasting a really solid book yield of 4.9%. That is a fantastic 40 basis point increase in this climate.
All of this prudent capital management translates directly to the balance sheet, tangibly building underlying value for the shareholders who stick around. Honestly, if you're ever studying how to build underlying value in a stagnant market, this is what it looks like. Their book value per share, including the deferred gain, grew an impressive 9% to $52.58. Even their adjusted book value per share grew 5.6% to $53.26 over the last year. They've absolutely perfected the art of doing more with less. But of course, the question is, what comes next?
That brings us to Section 3, the path forward. Let's talk about their strategic expansion.
Looking ahead, it's abundantly clear that they aren't just cutting back to artificially inflate their growth metrics. You can't just shrink your way to greatness forever, right? They are strategically planting seeds for future expansion. Profitable growth remains their true North Star. To achieve that, diversifying their workers' compensation product offering is absolutely paramount. In June of this year, they officially marked the successful launch of a brand new excess workers' compensation product line. This is a massive move designed specifically to target self-insured enterprises, which allows them to capture a totally new segment of the market and diversify beyond their guaranteed cost products.
Which brings us to the end of our analysis today. The final thought I'll leave you with in this explainer is a broader strategic one to consider for your own investing or business framework. Can other companies replicate this success? In an era where Wall Street often demands endless top-line revenue growth no matter the cost, is strategically shrinking your volume to ruthlessly prioritize profitability actually the ultimate blueprint for sustainable, long-term corporate growth? Looking at the data we just unpacked, I think you'll find a pretty compelling argument that says yes. Thanks so much for learning with me today, and I'll catch you on the next one.